Hi, this is Dustin with Dustin's Dollars. Today I'm going to be talking about Enviva Wood Partners, or I guess it's just Enviva nowadays, talking about their future growth of their wood pellet production and the impact this could have on their future earnings and what the state of the company could look like in a couple years for rough valuation purposes. Before I begin, let me remind you that I'm not a financial advisor or a financial professional of any sort. All opinions I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in Enviva, so this video should be for your entertainment purposes only, because I could be wrong about everything I say in this video, and you need to do your own research before making any investment decisions. So previously I talked, sort of an overview of Enviva and then talked about their near-term financials in terms of how safe their dividend, is likely to be in 2023. What I want to talk about today is their, the future growth and how they're going to actually grow the coverage of that dividend, which is very juicy, 12 or 13% as the stock sits right now. So as I mentioned, I was talking about before, they have a number of existing wood pellet production facilities. These are all under, mostly under long-term contracts, right? They had that roughly, don't quote me on this, roughly $20 billion backlog of, many, many years in the future, more than a decade, for a lot of these contracts. And in addition to that existing production, they are building new plants, right? And they have these two plants in Alabama and Mississippi that are called out right here. The Eeps in Alabama, I don't know how to pronounce it, and then Bond, Mississippi. These are plants that are under, the one in Alabama is under construction. I think the one in Mississippi is slightly before construction at this point. But they are building these plants. And I want to jump real quick. By the way, this is their most recent Investor Day presentation that was just posted a couple days ago, which actually gave a tiny bit more insight into the company, into how they explicitly called out how they plan to finance the new plant. Let me scroll down and talk about their new plant. They have this nice, if you want to see a cool picture, here's the overview of their new design of their plants. And the more important thing from the investor standpoint, obviously this is very important for the operations, but from the financial standpoint, they have a rough overview of what they expect for this new plant design, right? This is a 1.1 million metric tons per year plant, larger than their other plants that they've already had. And then they talk about some of the improved utilization and some of the things that they think are better with these designs. And so overall, they expect each of these new plants to cost about $375 million, and to then, once they're up to full production, be able to generate $90 million of EBITDA per plant. And so that's a pretty fantastic return on investment they can start realizing fairly quickly. And they are planning, as I said, these two plants, and then they have some unstated, future plans to really build even more plants. And I think they basically have two that they are in the early stages on already, but particular sites selected after the plants in Alabama and Mississippi, for a total of four. And you look elsewhere in this presentation, they talk about building 4 plants in 4 years. That really grow their production capacity. Today, I'm going to look into the details and really only look at these first 2 plants that are clearly selected sites and are already either under construction or imminently going to start construction this year. As I say, for the plant in Alabama, it's already under construction. For the plant in Mississippi, they plan to start the second half of this year. So if you look at that, they have a nice breakdown here. Let me go to it here. And they have shown year over year how they expect things to go. I'm going to go over this in just a second, the sort of the Cliff's Notes, but I have some slightly more detailed numbers that I wanted to build up to that. So what I also did here, this is a spreadsheet that I pulled some numbers, and let me zoom in a little bit so hopefully it's a little bit easier for you to see. I have a column here for every quarter. I have a row here for every plant that they have already had, and then that is under construction or planned for construction, right? And so this table here is showing their production capacity in terms of annual production in metric tons per year per plant. And then down here, I've summed it up for, every quarter, what their rough, their what they call their nameplate capacity should be, right? How many they ought to be able to produce if everything is, goes right, which is not always the case, but this gives us a rough starting point. And you can see here it kind of goes up over time, where in end of 2022 or beginning of 2023, they're at about 6,200 million metric tons per year. And that by the beginning of 2025, with those two new plants being fully ramped up and some smaller expansions that they noted, that they have at their existing plants, they're going to ramp up to about just tad shy of 9,000 million metric tons per year. And so that's almost a 50% increase in their overall capacity, right? And they're only adding two new plants, but these two new plants are huge, right? A lot of these plants are 600, even some of these older ones, I guess, are 400. I don't know if they're older, but they're smaller. These new ones are 1,100, so they add a lot of capacity. And then they also have this plant in Loosedale that is, I think, already that is still ramping up, if I recall. So, anyways, this actually shows the, visually what this production ramp is going to look like over time. Again, each bar here is 1/4, and it shows starting from Q3 of 2022 all the way through to basically the end of 2024. And you can see it does go up over time as those plants are built and ramp up. Now, I also went through in some of the details, and based on that production capacity, I sort of estimated the impact for the EBITDA given the increased production capacity for each quarter. And then I, came up with numbers here. I adjusted them downward slightly because my estimates for the adjusted EBITDA here, given their increased production, were slightly above what they projected. What they're saying, 380 in 2024 and 480 in 2025. I had originally got 396 and 486, so they were certainly in the ballpark. But I went with their numbers since they're slightly lower, and I'd rather be more conservative. And I plug this in here, and this is me actually going through some of the more detailed numbers on where are they getting the money, how are they funding these plants, what is their balance sheet going to look like year over year. And so this is a bit probably difficult to follow, but I have this whole section up here, rows 2 through 9 are showing at the end of each year, 2022 through to 2025, roughly what does their balance sheet look like. You'll notice there's no, and this is just in terms of their debt and their cash. And really, I left off the cash item because they don't really have much cash to speak of. It's all this restricted cash that is sort of earmarked for construction. I think that's cash that they borrowed or they got from issuing bonds that were specifically for these plants. And so that's what this section up here is. And then down here, I go through kind of their operations and then what the operations in each year, what changes that's going to cause their balance sheet. So in 2023, they're going to make about $305 million, but they're going to spend slightly even more than that in cash interest, maintenance, capex, and dividends. And then they're going to want to spend $370 million in growth capex to build those two plants to fund that construction. And so overall, even after the earnings, they're going to have to come up with $385 million to spend in 2023. They have $248 million of restricted cash. I assume they spend all of that in 2023. And then they also have to draw down the revolver by $137 million. So at the end of 2023, I figure, their balance sheet, all their debt looks the same, but they've drawn down the revolver even more. So their balance on that is higher. It's up to $225 million. In 2024, hi, Vaseline. Sorry if I mispronounced that. Me waiting for Tel videos. Sorry. Yeah, I don't have. There's not a whole lot that's new on Tellurian, right? We're all just kind of waiting. Sorry to interrupt the Enviva stream for anybody who's watching for that, but that's. I'd love for there to be something material there. There's a lot of speculation. Maybe I'll do a stream for speculation since so many people are interested in it, but there's not a whole. We're kind of just waiting at this point. Anyways, back to Enviva, their operations in 2024. I think they are, increased EBITDA because they're going to have increased production, and they're actually going to cover their dividend here, right? I put this out just as a nice metric to see what their projected dividend payout ratio would be. In 2023, I think they're going to be not quite covering it, so they're going to be over 100%, but they're actually going to be covering, I think, in 2024 and in 2025. And so they're going to also want to spend, a fair bit to finish up construction on that plant in Mississippi. And so they're going to spend $255 million in growth capex, and they're going to get a bit of that covered by earnings, but most of it is still going to have to come from somewhere. They talked about issuing. They said they have $275 million in bonds that they intend to issue through the Mississippi some state authority or something. I can scroll down and find it. If you want to go through the details here, they talked about, oh man, right down here. So they talked about their, near term for 2023, 2024. They talked about issuing 275 million more dollars in these tax exempt bonds that are available to them. So that's, I think, what we're going to see here. In the end, what that means is that actually means I think they're going to be able to take some of their earnings and pay back a bit of that revolver, because these bonds, I sort of just placed it in 2024, although I think probably they'll be able to issue it in 2023 and use some of it in 2023 for those construction costs. But the net effect is that they actually should be able to pay down the revolver a little bit in 2024. So this is what I think the balance sheet will look like roughly by the end of 2024. Then in 2025, again, this is my hypothetical. If they stopped building new plants after just these two that are currently planned and are going to start construction soon, that is not the company's actual plan. But I kind of wanted to get a rough look at where are things going to be in 2025. That's my current look at things, to sort of get a medium term picture of the company. So if we take this hypothetical scenario, in 2025, they wouldn't be spending on growth capex. They would have adjusted EBITDA of $480 million. Thanks to those two new plants being in production, they're going to have they're going to pay more in cash interest because they have more borrowings here. But overall, they are going to be covering their dividend, and they're going to be able to spend or pay down that revolver. And so I think by the end of 2025, hypothetically, if they didn't build more plants, you could see this balance sheet start to look a little bit better. And add this up. I have this little section over here where I kind of get to the punchline, or the bottom line, you would say, or by the end of 2025, in this hypothetical scenario, they had about $1.6 billion of debt outstanding. Let's figure they have 80 million shares outstanding. They kind of say they're not going to raise more, but I think I think they issue some new shares because of their dividends that they pay in kind. And then, they're going to hand out some for stock-based compensation here and there. Let's just figure $80 million 80 million shares outstanding, because I think they're at 74 right at the moment. So not a huge increase, but some dilution that happens. And then using that $480 million in EBITDA that we would, project for 2025, we can look at some rough valuations, given certain multiples, and you can go from a range from 5 to 15. And I think 15, might be high, but it's also worth considering that this company is going to have, for these plants, they're contracting them out for a decade or more, with built-in price escalations on that, and they have this again, like $20 billion backlog. So I think when they start to cover this dividend, and it's clear that they're paying down debt, and they're going to be able to do that over the long term, that I wouldn't be surprised to see some of these higher valuations applied, because this really would be kind of a safer company with that long term, all those long term contracts, and frankly a history of operating, right? They've already got this history, and now they're growing. So anyways, these are the potential share prices you could see, anywhere between $10 to $70. I know that's a huge range, and then that's using an EV to EBITDA multiple. You get a slightly smaller range if you use some different metrics to kind of value it. But I personally am thinking, again, this is definitely my opinion, that a 7.5 would be, I think, conservative by that point, which is roughly where the stock is trading today. And that's not very exciting, except when you think about it, you're getting a 13-14% yield, almost on your money. I think it closed right around 26 today. And that we do that 362 over 26, you're getting almost a 14% dividend. And you're not, if the stock doesn't erode over time and you have potential upside, depending on if the market starts to reprice it, that could be pretty material. And I also put this as another way to view it, right? If you look at what's their dividend yield at these various price points, if they even just continue the same dividend, they could also up it. Once they're covering at 6-7%, and they say, hey, we've got these long-term contracts, we're slowly paying down our debt, let's return even more of it to the to the shareholders, that might be a pretty attractive option, especially considering that a lot of the insiders, they hold a large portions of the company. They'd love to have more dividends in their pocket, I'm sure. So, what's the market going to bid it up to when they realize that this dividend is actually safe? And this is no longer it's no longer an MLP. It's an actual corporation, so they don't get the differences in capital being returned that go along with being a partnership. They're a normal, I guess C corp, S corp. I'm not sure, but I know that they're paying an actual dividend, not a return of capital at this point. And so the market could bid this up to a 6 or even 5% dividend yield when it's viewed as much safer. And so that could be another way that folks might view the valuation on this company, and you could see some significant appreciation if that were to happen. Kind of as I mentioned, if you want to go even in more detail and look at what they're projecting for, sorry, which slide was it? Slide 12. For what they're projecting to even grow more and build even more plants, where they expect, even to continue. Where's the, so Greenfield, CapEx, right? Greenfield CapEx every year here. They're planning to build more and more plants. 4 plants in 4 years. It's somewhere in this presentation. And so they're planning to grow even more past this. So it'll be interesting to see how that plays out. I think, they'll at least have options once they get to this point where they have these 2 plants in production and they're ramped up, they're already contracted, and they realize, or not that they realize, but they have options once they can actually just sort of take their foot off the pedal of growth and actually cover that dividend. So that's kind of how I'm viewing this. Again, I don't think this isn't going to 10x. Well, I mean, who knows? But I'm not expecting this to go to the moon, but you could see some pretty healthy returns from the current share price as folks start to revalue it as a safer dividend paying company. That's kind of my thesis, and that's why I've been buying in. I'm probably going to continue buying in as long as the stock is frankly under $35 if nothing changes. I'm going to be DCAing into this over time. Hi Jasper. Jasper says, nice vids, keep it up. Thanks for hopping on the stream. That's everything I had to talk about today with Enviva. It's a company I'm building up my position in because those dividends look nice and juicy, and I will be reinvesting those as long as the stock stays low as well, and growing my position that way. Overall, I think they have a pretty solid position. Given those long-term contracts, that's just a really, really nice thing to see in these companies. So, all right. Jasper says, do you want to make a portfolio video? I hadn't considered. I didn't think anybody really cared. I'll think about that. I have, my style is mostly high risk. All right. Well, I think I'm going to hop off now. It is great to see some folks on here. I think I might, I need to negotiate with my wife, and I might see if I can have some sort of regular times to have streams, so I can have folks, hop on, and we can have some more back and forth at a regular time rather than me hopping on at, random times whenever. But that remains to be seen. So anyways, thank you very much, Vaseline and Jasper. Hopefully I'm pronouncing those correctly, for hopping on the stream. It's great to see some folks, and that's it. So have a good one.